we seem to be closing the week, possibly if we can close today, over $30 back above the silver squeeze highs. And if we can close June above 30, be in pretty good shape. It looks like silver's bounced off the 50-day moving average. Don't know if that will hold, but so far for the month of June, which has been a cool down pullback month, staying above 30 for the month would be what we want to see. I believe the yen is a critical component of the global Keynesian system that was set up in the 1970s. Japan has been an outpost of the dollar-based monetary system since its inception as a fiat system. I do firmly believe that once the yen goes, the entire global Keynesian system based on the US dollar will go with it.
After a brief pause, silver prices remained in the limelight. Feeble US economic numbers followed, fueling hopes that the US Federal Reserve would cut interest rates this year. The outlook for silver remains bullish in the short term. The prospect of multiple Fed rate cuts this year, coupled with potential economic weakness and geopolitical tensions, is likely to provide continued support for silver prices. In the discussion, seasoned financial analyst Rafi Farber mentions the current silver position and predicts that silver will remain above $30 through June. Rafi Farber states something significant is happening with the dollar from a technical perspective. He notes three key triangles in the dollar's history, including 2001 to 2020, which was resolved just before the COVID-19 crisis. The second triangle from 2010 to 2014 ended with an oil crisis, and now a third triangle has been forming since 2021, while Farber believes it is close to resolving. Based on his analysis, Farber predicts that resolving the dollar's current pattern could trigger a financial crisis, affecting liquidity and interest rates and likely boosting demand for gold and silver as safe haven assets. Specifically for gold, it is believed that the US dollar will be revalued and depreciated, leading to US treasuries being abandoned as global reserve assets. This will trigger a doubling of gold prices, with expectations that by 2030, gold prices will rise to between $7,000 and $15,000. Over the past few decades, the United States has gradually evolved into a net exporter of debt, but now the situation is changing. The US government sees a return to commodity exports as a national security issue, and to achieve this, the US dollar must be devalued. Furthermore, Farber mentions a very large triangle from 1985 that might soon resolve, potentially causing a significant financial shift. Now, we present the clips of Rafi Farber's insights from his recent video. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Now, there is something going on with the dollar in a technical sense. These patterns are more of an art than a science, but I did notice this, that whenever the dollar gets into a consolidated triangle, a crisis usually happens when that triangle is resolved. So we have three examples of this, one nested within another one, and then the third one that is happening now. So we have, if we look first at this black one, this is a long, long triangle from the top of the US dollar index in 2001, it looks like. And the triangle was hit in 2017, and it resolved itself right before the COVID crisis, the lockdown crisis over here in 2020, and then we had a huge financial crisis over here. Within that large triangle, we had nested within it a smaller one from 2010, 2014. 2010 was the end of 2008 financial crisis when the dollar sprung higher and then hit a low when gold and silver hit another high here in 2011. This is around when silver hit $50, if you remember, and I'm sure you do. And then we had another triangle closing in at the end of 2014. And then all of a sudden, when this was finally resolved, we had an oil crisis. The price of oil fell to, I think, around $26 ultimately in 2016. And OPEC was in trouble. It was a whole thing that started in December 2014 when this triangle was resolved. Now we have a third triangle that is forming and almost at a resolution here. From 2021, the all-time low in interest rates and the peak of the COVID printing insanity, to here, which was the dollar high in 2022, and we are in a very steep triangle that appears to be on the verge of resolution over here at about 105.2, exactly where we are right now. I didn't check, but somewhere around there. This could manifest itself in many different ways, in a reverse repo crisis, in a repo crisis, in a repocalypse, something like that. It doesn't matter exactly what the nature of the crisis is going to be. This is just a close-up of that same triangle from 2021 to now. You can see here that we're sandwiched between about 103.5 and 105.17, and we're very close to this resolving one way or another. I personally think it will go up as we head into a final dollar crisis when liquidity looks for dollars because we need to service debt and everyone is suffering from high interest rates right now. So we have one liquidity crunch still ahead of us. And it's not going to take long. And from then, we're going to start the final printing round, as I've been saying since I began the Endgame Investor. Now, if you want a little bit of fun, I'm not sure how valid this is, but I saw it and I just wanted to put it in just for kicks here. So we have massive zoom out for fruity circus chartist triangle enthusiasts. That would be a good band name. I thought it sounded pretty nice, so I just put that in there. We have a triangle maybe from the top of the dollar in 1985. I think it was like 165 or something like that. Maybe I'm off by 10. It was some crazy amount when the dollar was strengthening off the back of Volcker's hikes from 1980. It looks like we've tagged that triangle here in 2022 at that top. And if you want to count this as a triangle, it looks like this humongous thing is going to be resolved pretty soon. And that's going to be pretty big.
During the interview, Rafi Farber said the weakening of the yen could lead to intervention by the Bank of Japan. Farber expresses that Japan might sell U.S. treasuries to support the yen, but this has only temporary effects. He believes the yen is highly sensitive to bond market changes, with the Bank of Japan holding over 50% of Japanese government bonds compared to the Federal Reserve's 12.8% of U.S. Treasury bonds. The yen capped its longest losing streak since March, ramping up the risk that Japanese officials will again step in to prop up the currency. The currency traded around 158.90 per dollar, near the closely watched level of 160 per dollar. It weakened for a sixth straight session on Thursday, the worst stretch of losses in 3 months. On Friday, Japan's top currency chief, Masato Kanda, reiterated that the government will take proper action as needed. While shifting focus to the next aspect, Farber emphasized that the rising repo levels indicate an imminent financial crisis, predicting a severe disruption unless the Fed prints more money soon. Let's get back to the interview.
We have the yen breaking up, which means breaking down because the higher this number, the weaker the yen is. This shows 158.26, but this is from yesterday. We are at 159 now, the all-time high being up here where that candle is at about 160 something, 160 point something. We could break that at any time, which would spur more intervention by the Japanese central bank, the Bank of Japan. And speaking of intervention from the Bank of Japan, point being that the country with the biggest exposure to the U.S. bond market, to the treasury market, is Japan, and their currency is crashing. And what are they going to do when their currency crashes? They will have to sell treasuries in order to buy U.S. dollars, in order to sell U.S. dollars to buy yen to strengthen their currency, which they've done, but it hasn't really done much other than keep the yen strong for another few weeks. But the market is a lot stronger than the Bank of Japan. I want to give some perspective here as to the problem with the yen, that it is mostly bonds. And why is that? Well, this graph here from Bloomberg shows that the Bank of Japan holds over 50% of the outstanding bonds, Japanese government bonds. So meaning the yen is the bond market. And if Japanese interest rates go higher, then the yen weakens because the yen is the bond market. And now to compare to the Federal Reserve we have in the title, I calculated, if you calculate the amount of treasuries on the Fed's balance sheet versus the outstanding debt of the United States, you get the Fed owns 12.8% of the outstanding treasury bonds, and the Bank of Japan owns 54. So that's like 4 times what the Fed owns of its own bond market, meaning the yen is much more sensitive to Japanese government bond interest rates than the Fed, and the dollar, is sensitive to dollar interest rates. Now, there is something going on with the dollar in a technical sense. These patterns are more of an art. If you're asking me what I'm looking at these days to try to triangulate in time the next financial crisis, I'd have to say it's this chart. And to explain this, this is the proportion of bank reserves that are taken up by repos, by overnight repos. Overnight repos is the bank lending between banks that I mention a lot, and that is the key to the basement or the dungeons or the sewers of the monetary system. So the repocalypse happened in September 2019 when repos took up about 85% of the outstanding bank reserves available. Now, today's number that just came out yesterday, actually, is 2.021 trillion. That's the amount of overnight repos now per night, as of last night, divided by 3.366 trillion. That's the amount of bank reserves available. So the amount of repos taking up, the amount of reserves taken up by repos, is about 60%, up from 57% last week. That's a big jump. Once we get to 85%, we should be in crisis territory. It doesn't mean it has to go that high, but reserves are falling. Repo volume is rising. So we could be here within the next, 2-3 months, maybe a little longer, maybe shorter. But this is definitely where we're headed, and we're not going to reverse until the Fed prints again. I want to show you where that chart comes from. So on the top, we have security overnight financing volume. That's the repo volume. How many dollars are switching hands between banks every night? The last repocalypse happened around here when it was 1.2 trillion a night. Why did it happen there? Because the amount of reserves available at that time at the same date here is 1.38 trillion. So 1.2 trillion over 1.38 trillion, that's about 87%. That's where it comes from. So here we are here. Now we have 2.021 trillion a night. You can see that the volume has been rising up steadily since around July 2022 on a pretty consistent slope. And reserves now are 3.366 trillion. The regional banking crisis happened around here with 3 trillion. We're at 3.366 trillion.
Looking ahead, growing worries about geopolitical tensions, the prospect of China industrial demand, a robust rally in gold prices, and Fed policy uncertainty continue to support silver prices. How will these potential financial shifts impact your investment strategies in the coming years? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.